Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Monday, April 8th, April, the letter J, of course. J is a letter that the futures traders use, Dan. Just wanted to let you know.
What month do they use that in?
That would be April.
Yeah. Will you explain you say that. So each month is assigned a letter. And
each month has a letter.
And the reason being, okay.
Well, I mean, if you're going to be down there in the pits, you need a way to do things quickly. And, it's very difficult to spell out like a February, for example. So instead of spelling it out, you just put the letter G, like me, letter G.
Okay.
G Swizz.
You're a guy, little guy. But Guy, today, before we get to the rundown, before we talk about what we are going to be, breaking down, demystifying, doing on this edition of the Market Call, today's kind of an interesting day because not in the markets, but like, where are you going to be viewing this total eclipse of the moon and the sun?
Well, so it's 1 o'clock on the East Coast. Apparently, this thing starts around us somewhere after 2:30. I think it's peak eclipse around 3:30. And then I guess it sort of wavers into the 4 o'clock hour. I will probably be in a vehicle on the way to New York City's Times Square. Amanda's texting us now. I'm sure she's saying stop already. But she's not, actually. I'm surprised. So that's where I will be. I'm not as intrigued by it as others, but, that's me.
Yeah. Well, it's interesting. It's one of those things where it happens so infrequently, you probably feel like it's
me being right on the market.
Oh, there you go. I will say this. One of my favorite Pink Floyd songs is Eclipse, and it's the last song on Dark Side of the Moon, which is interesting because I was listening to the New York Times Daily this morning, and they had this guy who's he's literally been to as many as eclipses that he could get to in the first one he saw was in 1970. Well, he said he's a nerd, okay, and he studies this stuff. And in 1963, there was a partial eclipse. He was a young boy, and he basically said the next time that there is a total eclipse, he is going, and that was 1970. And he convinced his parents to give him the car, and he drove from Staten Island down to North Carolina, and he watched it. It's pretty fascinating. I'm going to go out there on the roof, and I'm going to watch the eclipse, guy. I'm going to do it safely.
Please do it safely. I encourage everybody to watch it safely. By the way, the Rangers won last night. Before we get into it, they're in really good shape here, and we have a little basketball game tonight. University of Connecticut Huskies take on the Boilermakers of Purdue. Okay, so there's your housekeeping. So let's take a look at today's rundown. I love this. Check this out. Make or break week for the markets. A little hyperbolic, but you know what? It actually may be true. And then we did a little alliteration for you, Dimon's Diatribe, and what's happening or having with Bitcoin. I mean, that's Amanda Diaz at her very best.
Yeah, I think really what we wanted to go with, AD, was what's happening with Bitcoin. But again, interesting price action there. And it's funny, Guy, the one thing about Bitcoin, we're going to hit it a bit. It just seems like all the issues that we had in that last kind of retail fueled, kind of frenzy in 2021, and all the stuff that was going on in social, and all the meme coins and all the NFTs, and then all the fraud, you know what I mean? It seems to be, we have turned a page, you know what I mean, on a lot of that, which I think is kind of interesting. And again, I think a lot of folks that I would not have expected a few years ago are talking about Bitcoin as a macro risk asset the way they would about many others that we have traded and watched and quote, you know what I mean? As we think about the things that move around, about economic stuff, about monetary policy, all this sort of stuff. So it is interesting to me.
Listen, I will tell you this, the fact that gold is rallying with rates going higher, dollar rallying against some currencies, and Bitcoin rallying with commodity. You have a lot of odd things happening right now. And I think a lot of it's predicated on, again, Fed policy and those types of things, but not only here, but abroad. Anyway, let's take a look at the week, because this is a pretty interesting week in terms of make or break. And here you go. That is a great looking slide, all the different colors for you. A little Roy G. Biv. Not really, but close enough. But to me, the fact that you have probably 9 or 10 Fed heads speaking this week, and I think Austin Goolsbee speaks 3 times this week. He may be speaking as we speak. and then another 2 times. That's interesting. I don't know what to make of it. But then obviously the big thing, CPI on Wednesday, I think everybody's going to be looking at. Then obviously JP Morgan and the other 2 banks on Friday. So there's a lot to dissect and to basically digest this week. But first and foremost, I think it's going to come in the form of Wednesday.
Yeah, CPI. All right. So let's just talk about this. This is obviously an inflation reading. One of the reasons why, we've basically, let's pull up that CME Fed funds tracker here. We've gone from 6 expected rate hikes or cuts, excuse me, rate cuts this year to, 3 to, who knows, lots of folks are saying that maybe just 1, and we don't get that until November. You see the probabilities for that June meeting. They're basically cut. They're basically 50-50 right now. They're down from what? There was an 80% probability, I want to say a couple months ago, and now it's below 50%. It really feels like if we have data on Wednesday morning that just kind of is in line with expectations, it doesn't get softer, Guy. I mean, this is going to kind of evaporate a little bit here, right? And if you look at just, I guess if you want to focus on yields, if you look at the 10-year yield, it's at 4.43. If you look at the 2-year, which should more closely track Fed funds, right? We see that up there at 4.78 or so. It seems like your call of higher rates, it seems to be on the table here. And that was also one of the things that we'll maybe spend a little more time with Jamie Dimon. He's saying that he could see, rates going to high single digits here. And so you tell me, make or break. You tell me if that comes in hotter than expected and can't be explained away the way the March jobs report was, right, which was equity friendly for some reason. Yields went higher. I mean, at some point, there's got to be a yield level, Guy, and there's got to be a percentage of cuts, you know what I mean, for this year that just make equity investors a little bit more nervous about valuations here with S&P at, above 5,200 and trading 21 times.
Well, I thought it would have been 4.25%, and equities would have sort of caught wind of it or noticed it in a manner that has equity sell off. That obviously didn't happen. So as we approach 4.5%, maybe that's it. I don't know what the line of demarcation is, but what I'll tell you is if you look at this chart here, I mean, we're in a pretty decent up channel basically from late last year, early this year. I mean, your eyes can see it. I mean, we can draw the channel if you want, but trust me when I tell you we're there. Now, the top of that channel probably comes in just a wee bit north of 4.5%, and we'll see what happens if and when we get there. But there's a like to lot about if you're negative bonds or think yields are going higher. There's a lot to like in this chart without question. Now, with that said, why are equities hanging in there? I'm hard pressed to understand that for sure. But then I look at gold also hanging in there, and I'm like, there's just a lot of strange things going on right now. So I think the bulls will say the reason why yields are going higher is the economy's on firm footing and things are fine, which is the reason why you'll pay a premium valuation for the S&P 500. I am not of that belief, but I think that's the counter argument to my negativity.
Yeah, I guess when you think about it in that regard, I mean, so the premium valuation, the S&P is really coming from the top 10 stocks in that index, okay, which are basically, what they are. They've been obviously, investors are very excited about generative AI. It seems like something that Jamie Dimon is also fairly excited about. And so they're getting a premium multiple, and many of the other sectors and hundreds of stocks in the S&P 500 are probably trading in line with the average multiple, you know what I mean, that we've seen over the last 5 and 10 years. And we know that we track a bunch of that data via FactSet and our main man, John Butters, who's the senior earnings insight analyst over there. And so I guess my focus on valuation is a tough one. It's like, what do you think the pace of those names, there they are, you know what I mean? Like if they can continue to contribute to the S&P 500 earnings growth at a higher than expected rate and justify, this double digit expected earnings growth in 2024, and they're driving it. And then the guidance that they give as we get to it in Q1 earnings period, suggests that it's achievable, then the S&P is going to continue to trade at a multiple that is higher than the average. I mean, it's that simple. And so, I mean, it's a tough one. I mean, you tell me, what's Microsoft? We know Apple's not going to be that impressive. NVIDIA at some point this year is going to show deceleration. Amazon and Meta, and Google, they're very much embedded in this, generative AI trade. Some are getting rewarded on a multiple basis, and some are not, right now. So to me, that's the thing. And that's why when we spend so much time talking about generative AI, it's like sooner or later, if we don't see the receipts, Guy, then the S&P 500 is really going to be vulnerable on a valuation basis with yields here. And, that's my 2 cents.
Right. We don't see the receipts. I'm glad you said that, because a lot of this has been built on I don't want to say the hope, but, the belief, obviously, that there's this whole new addressable market. But at a certain point, you have to start seeing the revenues that support that. But I'm glad you mentioned NVIDIA. I'm not here to pick on NVIDIA, but we've said this now a couple dozen times probably since March 8th. But if you throw up an NVIDIA chart real quick, you'll see what I'm talking about. And again, for any of our new listeners or viewers, I would point out that Friday, March 8th, you had this engulfing pattern, which, again, it's a big deal. Engulfing pattern meaning we basically on that day made a new all-time high. We traded higher than the prior day's high. Then we basically engulfed the prior day's action and closed lower than the prior day. You just don't see activity like that. Now, you did have a run-up in the stock that appeared as though it was going to render that day moot. But you know what? It never violated those prior highs. And here we are trading, I want to say, around 872.5, 873 or so, with a stock that, again, listen, I understand the run that it's had. I'm just looking at it through the lens of March 8th until now. Hasn't traded particularly well. I'm going to say again, and if I'm wrong, I'll be the first to say it, but I do think that March 8th date will be a day we come back to in the months from now saying, you know what, there was something there technically, and that definitely was sort of a precursor to a broader market sell-off. And I just want to put it out there because we've been, I think we've been pretty vociferous in that view. At least I have.
Yeah, I would actually make the point, Guy, is that when it came back and tested those March 8th intraday highs, okay, so there was a 10% intraday sell-off on March 8th. We actually made, if they can stretch it out a little bit, make it a shorter term, we actually made a new closing high. So, Guy, look at that. We made a bunch of new closing highs. Like, look where it closed that
closing
day.
Highs, yes.
Yeah, so in some ways, it actually it even helps make your point that, yeah, it did test those intraday highs. It closed basically very near them, you know what I mean? Made a new intraday closing high. So the fact that they sold off for that, they weren't able to break out, I think that's kind of interesting. So again, a lot of bulls. Let's pull up that S&P chart, the futures there for a second, the E-minis. So a lot of bulls will tell you, hey, listen, the fact that we actually haven't cracked and we haven't seen some of the leadership make new highs, it's not bad. So we've talked about that uptrend. It's been fairly steep. I think at the highs last week, we were maybe close up 30% from those lows in late October. I look at this and I say to myself, it looks increasingly vulnerable. It looks like it's going to make a move back towards that 50-day, at least to test it. And that would basically be the lows of those kind of month ago levels or so. And I just want to, again, let's focus on CPI Wednesday morning. So Tom Lee at Fundstrat, okay, he's out this morning saying, bottom line, we see probabilities favoring rally in stocks post-March CPI report. But the March inflation print should represent the first solid reading of the new year, given the January inflation numbers typically struggle with poor seasonal adjustments made by worse the pandemic and subsequent yada yada. You got all that. Thus, the first March clean CPI print of 2024, or rather, we view the March CPI print as more representative of the actual trend in inflation. Okay, well, here's the deal. If it's soft, okay, so that means inflation is less than expected. Good news for the economy, I think, Guy, or good news for the consumer. I mean, in some ways, you could say the strength of the economy has to do with inflation, right? So you tell me what the stock market should be doing off a soft number.
Well, I mean, I think if it were to come in better than expected, so less hot than expected, I don't know what language resonates with people, but just put it through that lens. I think the market will rally. And, what's interesting, Tom is, I think, twice prior to this has made calls like this into this number, and has been right both times. If you go back and look, so he's going for a trifecta here, and it's hard to bet against him given his track record. But what I would submit just to counter that is, okay, I'll play the first clean CPI print of the year, but all the things that make up or theoretically should make CPI have been going up. I mean, they've been pretty much consistently going higher all along. So I'm hard pressed to understand how this number is going to come in softer than expected. But I've been surprised before. But to answer your original question, if this comes in less hot than expected, yeah, the market's going to rally on that. without question. It's been interesting to see what yields do, but I think the S&P will rally on that
All
for
right. So,
sure.
so the point would be that a less hot number, then the Fed can get closer towards rate cuts, which should be a positive for equity. I mean, listen, I
That's
don't
the
know.
interpretation.
I
I
know,
think
and
is
that was the
fair.
point. That's what I kind of alluded to with that jobs report on Friday. You know, all day I heard seeing, well, there's something for everyone. You know, when you see that report had something for everyone, for the bulls, for the bears, and yields went up a little bit, and stocks went up, and that sort of thing. I mean, reversing the prior day. You know, we thought Thursday's price action was kind of interesting. You know, listen, I think you just made a point to bet against Tom. You're not betting against Tom. I mean, he's basically saying that, you know, this is his view and, you know, like that's what he does. I think he likes to buy dips. I think a lot of our viewers, a lot of our visitor, you know, you know, folks are fairly familiar with that. Let's pull up that S&P futures chart though. Again, the E-minis here. To me, I actually think a break of that uptrend. You see that 50-day, you see that very lonely 200-day all the way down there near the breakout level from December or so. I think using futures, you know, one of the things that we love about them is that you can keep taking little bets against a level, whether it be technical against a number, you can set a stop, right? And so to me, this one looks kind of interesting here. Okay. Like I want to press this thing. So that prior support becomes resistance. Okay. So we are below that guy. So let's just say we have an S&P, we have the E-minis right here, where we have 52, you know, 53 or something. The high was 52.70 earlier today or so. I'd probably, if I were to sell, let's say this right here, okay, I might stop it right above that prior high from earlier today. So if you look at these levels here, you see it 52.53. Let's stop it at 52.7 at 70. My target's at 50-day moving average down there at 51.15. I mean, if you start getting this going in the right direction, if you kind of break those lows that we've already made in the last day, then what you do is you keep lowering that stop, right? And you keep kind of keeping yourself in the game or so. You don't want that stop to be too tight that you get stopped out, you know, too frequently, but you can get back in there, that sort of thing. So to me, 52, let's call it 53 or so, 52.70, pretty tight stop there, because if it breaks out and makes new highs, I just don't want to be this runaway short in the S&P E-mini futures here, but my target's clearly 51.15.
No, makes sense to me. I think the stop level's right. And if it starts working in your favor, in other words, if you were to sell something here short looking, obviously for it to go lower, it starts working immediately. That 52.70 stop, you can actually lower to your entry point.
Yep.
So you basically assure yourself of at least, you know, you're not going to lose any money theoretically with the stop at the level that you initiated the trade at. And then you're obviously looking for that downside level of support. What's going to be interesting to see what happens if, in fact, you are right, which, by the way, I think you will be. What happens if and when we get to that movie? Is it going to be a bounce off the 50-day, or is it a straight shot through it? I think that prior trend line that we've drawn, I think it makes a lot of sense if we go back to it real quick before we get to Jamie Dimon's comments. Now, you'll see we broke the trend line. We broke it to the downside. We briefly traded back up to it and tested it. And now here we are. So we've seen action like this before in individual names. Now we're seeing action like this in obviously the E-mini futures and the S&P.
Yeah, and just to put this move in perspective, if you were to have a move from 52.50 to 51.15 or so, I mean, you're talking about 2% in the S&P, and you know we've been tracking that data. We haven't had a down 2% day in the S&P in more than a year, which is pretty astounding. There's going to be a number that comes in much hotter than expected that just kind of wipes out, in my opinion, that wipes out any rate cut possibilities to after the November election. And then your market is going to have to, the stock market is going to have to trade on fundamentals. It's going to have to trade on the idea that higher input costs, higher yields, stronger dollar are ultimately going to weigh on U.S. corporate profits at some point. And if the stock market is a discounting mechanism, right, of future, you know, earnings and cash flows and the like, then at some point there should be a discount. And so I just think the low levels of volatility, even with a VIX above 15 now, and we were talking about a VIX that was below 13 about a week and a half ago or so, you know, it's telling me that again, complacency still rules the day, but sooner or later there's going to have to be some sort of price action that puts a little fear into these bulls who seem very confident in just explaining away every hot number, what the Fed's intention are. It doesn't matter anymore for banks that yields are higher here. Think about the last time the 10-year U.S. Treasury yield was trading at 4.5% or so. Think about where money center banks were, and think about where they are right now.
Well, the S&P, I think, was 500 handles lower, if I'm not mistaken. I think it was like 4,700 and change being at the lower end of 4,700. But to your point about, discounting all Jamie Dimon seems to be now, whether or not he's positioning himself to be Treasury Secretary or Fed Chair in a new administration, or the second Biden administration, I have no idea. But what I'll tell you is the comments that he's been making are pretty consistent with the comments that he's made all along. And I don't think rates are higher today because of his comments. I think he just happens to be right. And, you can read it right here, some of the things that he's been saying. And it mirrors, and I'm not suggesting he listens, by the way, but it mirrors a lot of the same concerns that we've had all along. So he doesn't paint a particularly rosy picture. I think what he's saying is the market's, I'm paraphrasing, but I think he's saying the market's way too optimistic given some of the headwinds that he sees.
Yeah, and it's also fascinating that, the outperformance of JP Morgan versus money center banks, their peers, Wells Fargo, Citibank, Bank America, is pretty fascinating because, last year at this time, there was still a lot of concern about these held to maturity, mark to market, like treasury holdings of some of these banks, Bank America in particular, that were buying lots of treasuries 3 years ago, right? When the yield was 0.5% or so, and you see where they are right now. And so those losses, right? Hold them to maturity, you're fine. Okay. But in the meantime, you're going to be suffering losses, right? And so what does that do? It constricts your ability to do a whole host of banking activities, right? For ratio levels, and the list goes on and on, right? So to me, it's just interesting that JP Morgan wins no matter what, when rates were low, when rates are high. But the fact that he's saying that he could see yields at high single digits, it's not going to be good for his peers. You know what I mean? Like, however they have situated themselves. I mean, he came out, I want to say a couple quarters ago, it was almost mocking many of his peers by saying we were not buying those sorts of securities when they were yielding that.
Well, again, not to pick on Bank of America, but I will. When the 10-year yields were 5%, I guess in October of last year or so, their basically hold to maturity losses, HTM losses, were north of $115 billion. Now, those are obviously unrealized losses, but that's what they were looking at. And that in Bank of America, that was vis-a-vis the fact that they basically were getting long treasuries, but the yields would go lower at the exact wrong time. I mean, they literally couldn't have done it any worse. So as yields start to creep up here, one has to wonder, what's going on at Bank of America, because my sense is there's been no offset there. But to your point, was he mocking them? Yeah, he probably was to a certain extent. And I think your other point that, they win regardless. I mean, they are the house right now in terms of the casino. I mean, everybody else is in there betting at the JP Morgan casino, and they win regardless. And they're sort of set up that way. And quite frankly, the environment in a lot of ways is and what I find really fascinating, we wanted to get away from too big to fail. But what's effectively happened is that's exactly what we've created now with some of these big money center banks, specifically JPM.
Yeah, just to be clear, I mean, if you look at, make this a 5-year chart, okay? And on the JPM, I mean, this thing is just kind of off to the races. And then if you look at a Bank of America, which is 2021 high was like $50. It's trading obviously 20-some% below that. Citigroup traded in 2021 as high as 80. It's trading right now at $62, right? So you see that right there. Throw Citi in there just to give you a sense of just how far they are off of their 5-year highs. You know what I mean? Throw Wells Fargo in there too. And then lastly, let's just end it with JP Morgan, just to kind of make the point here. So it's back near its 5-year highs, but JP Morgan is just off.
It's a completely different chart.
Yeah.
I mean, it's entirely different, and good for them. And there's nothing not to like here. I mean, quite frankly, I mean, there's a lot. The only concern I would have is as you get to these price to book, when you're starting to get to the upper bands of historical norms in terms of JP Morgan, that's when you get concerned. And we're probably getting close to that now. We're obviously going to know what their tangible book and their book value is on Friday, but just something to keep in mind. And we talked about this with Carter last week. I think the implied move is still about 3.2% up or down in JP Morgan, which I find fascinating given the run that the stock has had. If you had asked me to sort of think about it, what would it be? I would have said closer to 5.5%, 6%, or double what we are now. And that's obviously wrong.
Right. And last week we also looked at the XLF, and I'm trading it via the options. I was looking at April 19th expiration, the 41.5 put. So here we are at 41.79 or so. That 41.5 put last week was about 40 cents when the stock was, or the ETF was about 15 cents lower. So right now it's offered at like 32 cents, right? So again, not implying a lot, like a pretty epic sort of double top level. It doesn't mean it's confirmed by any means. JP Morgan does make up 10% of this, but that's how I'm kind of playing the XLF here, Guy Adami. But in general, it's interesting that you phrase that as Jamie Dimon, that 61-page letter. It's probably the last significant writing that he's going to have for his shareholders and the like here, and what he detailed there. And one of the headlines that I saw is about planning for intermediate term transition. So does that mean that he's going to be Treasury or Fed or something like that under a new administration? I'm hard pressed to think that he would be in a Trump administration, but possibly in a second Biden administration.
Yeah, although he did say, he made some interesting comments that you can be construed as favorable comments towards, former President Trump. Regardless, I know what you're saying. And I think, as much as he'd probably love to run for president, I don't think we're at a point where ex-Wall Street people are going to get elected anytime soon. So I think the obvious the next step for him, the trajectory for him, is one of those two positions. So there you go. Anyway, we both are on Instagram, as we say all the time, and each morning we put out what we're looking at. And this morning, and we've alluded to it a number of times, I put out the following. Yields continue to be top of mind for me. Something's got to give, and here we are. And I continue to look at this and say, man, oh man, yields going higher. And we had this conversation, so I don't want to belabor it, but I don't think I'll say again, I don't think the market is fully prepared for 10-year yields going higher. And that's what we've been seeing here, Dan.
Yeah, and I guess the point is, at some point, will there be some sort of data or something that basically causes, if you look at the move that we've had, from that 3.8 level in the 10-year, back in September or so, to where we are right now, or late last year, 3.8, to where we are right now, just below 4.5. It doesn't look too different than the prior months to the move from 4.5 to 5% or so. So, when you have Jamie Dimon out there saying I could see 8%, last year at that time, Jamie Dimon was saying the same thing. I could see yields at 7-8% or so. So maybe some hotter than expected CPI data gets this thing going, and that will be the knee-jerk reaction. So your point about something's got to give. The headline that caught my eye that I wanted to focus on today, Guy, was the CHIPS Act, the gift that keeps giving to the SMH, right? So the SMH is the ETF that tracks the semiconductor industry. And again, when this act was passed, I mean, we knew that there was going to be tens of billions of dollars doled out. And you made the point on many many occasions over the last year and a half or so, is that, this is a matter of national security, not just from the sort of geopolitical risks that are created by the fact that China wants to retake Taiwan. And you think about Taiwan Semiconductor, which makes 80 to 90% of the advanced chips that go out in the world. We've heard people, I saw this author, Chris Miller, who's actually on the Tape podcast with us. I want to say late last year, at some point, he wrote this great book called Chip War. I mean, he has often been quoted by saying that if there is some sort of like incapacity in Taiwan as far as the semiconductor production, you know what I mean? If you think the supply chain issues that we had during COVID, okay, whether it be about food, whether it be about oil, whether it be about, other, things that need to get around the globe, he's like, wait until you see what happens if that sort of like, and we did see it in the auto industry and other industries, right? And the like. So to me, the fact that, the US government is doling out not just to Intel, which is a US company, but to a company like Taiwan Semi to build plants, advanced chip plants in Arizona, I think that's a really smart thing. I think that's a good use of taxpayer capital.
Yeah, I won't argue with you that but one has to wonder what the Chinese think about this. Like, I saw this, I'm like, gee whiz, that's a giant FU to China, right?
Yeah.
I mean, and look, the market is not interpreting that way, but to me, it's just, I don't want to say an escalation, but it's not a de-escalation. Let's put it that way. And I know Janet Yellen's coming back, or she's still there, and she's saying, things are back to normal. She's full of shit, quite frankly. So
Well, I don't
again,
think she's
I don't,
saying that. Do you think she's saying that? I mean, what I keep saying,
I saw some headlines, something to the effect that, she was. It's seemingly she was happy with how the conversations went. I'm
well,
paraphrasing. So,
yeah,
but that's
I
what
mean,
pretty much what she's gonna say.
yeah, but except for the fact that the biggest headlines to me, Guy, out of her trip were a bunch of warnings. You know what I mean? And not only that, I mean, we're playing from a position of strength. If you look at our economy that's expected to grow 2% this year, 3% last year, and you look at the lack of growth there and the changing demographics and the like, to me, I think we've spent the last 10 years talking about this emerging China and this
Hmm.
access to their emerging middle class and all this sort of stuff. And under the surface, it's been really weak. And all you have to do is look at how they've basically taken, hundreds of millions of their citizens and they brought them into these cities, and these cities are now ghost cities. And like you think of like how levered they are to the property markets and what a dire situation that is. I mean, they're kind of screwed. So at some point, I think like to send, a little old lady like Janet Yellen over there and give some kind of like pretty straightforward, kind of warnings about stuff. I don't know. I think we come back looking okay, man. I
Yeah,
mean,
I guess. I mean, I'm not a huge fan, as you know, and
yeah,
when I'm not going to get bogged down in the Janet Yellen stuff, but we continue to trot people over there. It's probably the fifth or sixth person we've sent over the last year, and each time, and you can go back and look, each time the reaction right after is everything's great, and then a week or two later, China does something to sort of ratchet up the rhetoric. So I fully expect that again. And again, it started with this comments we had, or this news about Taiwan Semi, which to me is a bit. It is. I want to say it is a bit of slap in the face, but we'll see. Anyhow, let's not get bogged down in that. But if we pull a Taiwan Semi chart up real quick, you'll see. I mean, there is sort of a lot to like here, Dan.
Yeah. So that consolidation, kind of interesting. Yeah, you see that. So on a 5-year basis, it's consolidated above that massive double top, right? And we've talked a lot about that. And again, I think some of the worries there was just generally a chip downturn, right? And that we saw when we sold off a couple of years ago. Generative AI has been obviously huge because their ability to produce these GPUs has been amazing. They're doing them for the whole world, and we know that there is massive supply constraints at a time where demand seems really high. So you see that consolidation. We obviously see that intraday high. It's the same level that not the same level, the same day that we had that big reversal in Nvidia. But the fact that it's kind of hanging in here and it looks like it's held that uptrend. We just had that uptrend from the January lows. What's interesting to me though, Guy, is that you see that 200-day moving average. We are like 40% above that, right? And the SMA or the Taiwan Semi is up about, let's call it 40% from on the year or so. I mean, at some point, you know what I mean? Like, they're going to offer some sort of less bullish guidance on the demand front. And, you tell me where there's really little support once you get below that uptrend.
We've seen it before. I mean, regardless of people say, it's still a highly cyclical business. I mean, unless something is changed, if you go back and look over history, I mean, semis specifically are pretty cyclical. So if that cyclicality kicks in, be careful, because it's all you need is one inline quarter or one guide lower. And, we've seen it before, especially at these valuations, things cascade very quickly. So we're obviously going to keep an eye on this. Real quick, just pull up a gold chart, because the fact that gold continues to rally with yields going higher is something that most people would not have deemed possible. But yet here we are. 10-year yields have gone again up 60-something basis points since the low, and yet gold has gone up in lockstep with it, which I think is trying to tell a bit of a story here. So even on a day like today, for example, when gold has an opportunity to give some back, it's hanging in there like a champ. And I'll say it again. I continue to think we're in the early innings of this trade, Dan.
Yeah. Again, last week on Market Call, we were talking about, okay, well, I can see a pullback to that flag that we made just a month. You know what I mean? And, you remain a buyer on dips. You were a buyer on dips in the fall when it just seemed oddly weak for a whole host of reasons, right? Like you made this point. Actually, by the way, great podcast. Listen, Guy, when he's on Market Call, when he's on the Tape podcast, when he's on Fast Money with me, it's our show, right? It's our turf. You know what I mean? Like you get to do and say what you want to do when you want to say it. You were on someone else's podcast that I just listened to this morning. It was at the Wall Street Skinny, and you got to check out these two, and you're going to call them these edgy gals, right? Like this is Jen and Kristen, and we met them recently. Great podcast. They're great on Instagram. But Guy Adami, unfiltered for 1 hour, walking through his career. It was a real, I really enjoyed it, Guy. There was some stuff there that I did not know about you, and I've known you for a very long time, and you and I spent a lot of time together. That was fun. But
No,
I got to hear about your
they're
early days as a gold trader.
Yeah. No, it was fun going down memory lane with them both, and they're very bright. I think Jen went to Princeton. I think Kristen went to Yale, or vice versa. If I'm mistaken, I apologize. But very accomplished, and they're great on Instagram. They're great on social media. I was honored to do their podcast. I think they dropped it on Saturday. There you go.
Dang.
So if you're interested, you should definitely check it out, because it was a lot of fun. And it's fun when you get asked the questions and you can go back in time the way I did. It was a really, it was a lot of fun for me. I think they enjoyed it as well.
Well, my biggest takeaway also, Guy, is that, again, I came up in the markets in the late 90s. You came up in the late 80s. And even then, you could have made the argument how different the markets were in the late 90s than they were in the late 80s. But one thing is always consistent. And I think that no matter who you are in the market and how long you've been in the market, is like psychology of individuals as they take risk, as they manage risk, the psychology of crowds, all that sort of stuff. That's always the same. The tools in which you are expressing yourself in the markets, those change, like all that sort of stuff. So it was really interesting to hear. We'll put the link in the show notes. So check that out for Guy Adami. But going back to, you guys spent some time talking about gold, and the women, and they are smart, and they worked in investment banks, and they are like dropping knowledge on the Instagram and on their podcast. But they asked you, a lot of interesting questions. The one that it stuck out to me, and that's why I was talking about that low in October in gold. You made the point to them that was the exact time, right, in late October, when the Fed the cuts started getting priced in, where gold should have been acting better, right? But for some reason, they kind of fell off the bottom of the chart. And then it was that point where it went from 3 to 6 cuts being priced in. That's when it really started to take off.
Listen, again, I think there's a lot of reasons, and it was a great conversation. I encourage folks to listen to it if they have some time, but it was fun to go back and think about some of those things. And it was fun to be asked questions in a different manner than, through a different lens and through a different prism than we typically are. So I encourage you to go back and look. And I'll say again, and EY and I had a great conversation this morning that just dropped in your favorite podcast or on the On the Tape podcast about gold, and she's constructive as well. And with all the things that are going on, again, geopolitically, I think we understand, but more importantly, I think with central banks and some of these currency moves, gold's working, and I think it's going to continue to work. And what's interesting, and we'll end it with this Bitcoin, we teased it at the top of the show. I'm surprised because, I thought it felt like it turned, a week or so. It didn't. We're right back to the 72,000 level. A lot of people are talking about the market capper of the entire industry doubling from here.
Yeah. So interesting. So the whole idea of the halvening is, cutting the supply here. And this has been a bullish thing for Bitcoin in times past. There's a schedule in which this happens, and they don't exactly know what day it's happening. It's supposed to happen in late April. We'll put this article from Bloomberg in the show notes a little bit. But again, after such a huge ramp, as you see that guy, a 50% move in just the last couple of months or so, the fact that, over this last month, it's consolidated at these levels, which are new all-time highs for all intents and purposes. If they want to show, let's call it a 5-year chart or so, tells you that investors or folks looking at this asset class are still pretty geeked up. This is post the ETF, the spot ETFs that we've seen proliferate over the last couple of months. That was one of the big catalysts. And now, if you're looking at the halvening as another one, and then if you're looking at just the fact that despite yields staying bid and rate cuts off the table, seemingly, the fact that it trades this way is saying something very different to me that in times past than we've seen it in the mid to high 60s.
Stick around, folks. I do think, we started this show by saying, one of the more important weeks for the market. I actually do believe that. I know we were kidding around, but there's a lot happening this week. That's CPI on Wednesday. Tom Lee thinks you get long the market into it. We'll see if he's right. Then you have earnings at the end of the week, all this Fed speak on top of it. Stick around, because I do think things are going to get interesting. And all the VIX is lower today Now, you still have a 15 handle on the VIX, which is something I'm watching as well, Dan. So
yeah, one last thing. Let's pull that Bitcoin chart up and let's do a log chart from its existence, right? That goes back 15 years. This is really interesting, Guy. When you look at this chart, if I took the term Bitcoin off of this, okay, and so that's just the 5-year log right there. Not a bad looking chart, right? Like if you think about it, right? Smooth. And now let's go all the way back here. So let's go like, from its existence here. And it really looks like it wants to absolutely explode. And so, when you're talking about $1.5 trillion, I don't know if they can bring that back up here. I mean, this is not something that's probably that hard to move around when you consider whales own so much of this thing, right? So again, really interesting chart to me. And that's one of the things that we'll continue to focus on Bitcoin, because it does speak a little, it's supposed to be uncorrelated to the risk on trade, in my opinion, but it seems to be very correlated to it right now.
Folks, enjoy the eclipse. Be careful out there. Don't look directly in the sun like others have done, most notably elected officials. And we'll be back tomorrow. If tomorrow it's Tuesday, I get the feeling Carter Braxton Worth will be joining us tomorrow.
He will do. So Carter will be with us. All right. Thanks, everyone. See ya.